Hello and welcome to Buy, Hold, Sell. I'm Anna Dadic. Small caps are often seen as riskier and less researched than the broader market, but that's exactly what creates opportunity for the active and savvy investor. Joining me today are Matt Griffin from Maple Brown Abbott and Luke Laretive from Seneca to run the ruler over 5 small cap stocks that are across different sectors that are catching their eye. Luke, let's start broad. Where are you seeing opportunity at a sector or thematic level?
Yeah, we don't do much thematic investing at Seneca. It's kind of against the way that we think about the world working. We're kind of just a bottom-up fundamental investor. I think when we look back at things kind of ex-post, we typically can kind of bucket or group our ideas into, some themes or some styles, certainly. I think the first one that's kind of most prevalent in our portfolio right now is these kind of semi-distressed recurring revenue businesses. I sort of think about the likes of an Ordinate or a SiteMinder last reporting season. They've been market darlings, they've been highly prized, they've actually got pretty good underlying growth, but have been thrown out for one reason or another. So it's throwing up an opportunity for us. In the second bucket would be very typical kind of Seneca inflecting profitability. If we can find a business which can surprise the market with just how much cash it can print in a half or in a year, typically that's been a significant driver of alpha for us. And I think whether it's a Catapult, RPM Global, Energy One, there's probably 5 or 10 of these we've owned over the last 12 or 24 months. That's really the two kind of themes, I suppose, that we're making money out of at the moment.
Mm-hmm. Okay, Matthew, what about you?
We actually run a very similar process to Luke, so we're bottom-up stock pickers. Yep. Don't try to pick macro themes or sectors or anything like that. Having said that, where I see groupings of stocks in the portfolio at the moment, firstly would be mining and industrial services. That's been a long-held overweight for us. That sector's really come good in the last couple of years. I would say, though, there are still some stocks that are lagging there that the market hasn't really turned their attention to. So McMahon's being a good example of one that we think over the next 12 months could play a bit of catch-up, has some good catalysts available. Broadly in that sector, though, valuations are looking sort of fair by historical levels. I think what people are overlooking is just how strong the order books are. Contract terms have really moved in favour of the contractors, so there's much lower risk of project blow-ups than there have been in the past. And the balance sheet's in very good shape. So all these companies have good opportunities to deploy cash, grow the business organically or via acquisition, or ramp up dividends and buybacks.
Okay.
So we think that's well positioned.
All right, Matt, staying with you. What's at the top of your checklist when it comes to stock selection?
Yeah, 2 things. So our whole process is earnings-based. We say earnings drive share prices. Regardless of whether a stock's a growth stock, a value stock, a mining stock or industrial stock, as long as it has a growth profile that we like the look of and has a potential to beat consensus numbers, we will invest in that stock. That matters more to us in valuation and a number of other metrics which are sort of secondary considerations to us. Secondly, management is very important, and look, everyone will come on the show and tell you management is the most important factor in small caps for good reason. I would say we take it a bit more of a broad approach, so we look at corporate governance as a whole, spend a lot of time looking at who's on the board, what the skills are like, are board members incentivised through stock holding, and what are management incentives, their short-term and long-term incentive packages. Is that driving the right behaviour? We tend to find that bad corporate governance will sharpen share prices sooner rather than later.
Luke, what about you? What are your characteristics that you look for?
Yeah, I think, not dissimilar to Matt, I think there's a range of things that run kind of true regardless of, the kind of stock you want to buy. I think for us, management and understanding incentives really drives everything. So if you can find what's in the management's KPI, you can normally find out what the company is going to achieve, and you can normally figure out where the share price is going to be. So those sort of things are important. I think also, though, you've got to be able to identify value a number of ways. That might be a sort of sum of the parts, asset play type, opportunity where it's a 1 + 1 = 3. Other times you will be focused on earnings, like Matt was talking about, and that might be earnings that are really well appreciated and understood by the market, but their strategic value's missed, or it might be more a case of, the market's got really bearish about the growth prospects of this business, and you can buy something that's quite good for a very discounted price. So I think the key thing that's working for us, and I think works for all good fund managers, is flexibility, being able to make money, 4, 5, 6, 7, 10 different ways. And I think being able to identify what a good business looks like at various points in the sort of business journey, for lack of a better word, and different points of the business cycle, that's really what's key for us.
Okay, all right, let's get into some stocks now. First up, Bravura Solutions. This is a software company for the financial services industry. It's been through a turnaround phase recently, and they announced a new CEO starting in the new year. Luke, is it a buy, hold, or sell?
It's a controversial sell from me. I know this is a fundy favourite. A lot of my peers, colleagues think this is a great stock. I'm going to put my advisor hat on and say I don't think many of those people have actually used the midwinter product, and I don't think it's a very good product yet. I agree that it's got potential to be a good product. I agree that this stock is doing a cost out driven, I suppose, strategy here. But at 5.5 times EV to sales, to me, this thing's now priced like it's a high quality top line growth business. And when in reality, it's just a cost out story from our perspective. So if it was a better product, if it wasn't in such a competitive marketplace, and I think if the market actually understood the product application better, they wouldn't prize it so richly.
Okay, Matt, what's your take? Buy, hold, or sell?
I'm taking the opposite view. I think it's a buy. Look, for us, it's had a number of earnings upgrades over the past year. It's already had one for FY26 a couple of weeks ago. Importantly, that was driven mostly by top line growth. So while it's been a cost out story to date, we're actually starting to see a bit of sales momentum come back. I think they've cycled through contracts they've lost and they're getting a bit of momentum back on the top line. So that's very important while there is still some cost out opportunities there. Importantly, if you look at that business now, it's being run by a bunch of people who are ex-Constellation Software. I'd encourage everyone to look at the Constellation Software story in Canada. It's been an incredible story over the last 20 or 30 years. And if they can replicate a fraction of what they've done with Constellation and Bravura, I think there's a long way to go in this stock. I also spoke about incentives before. Management here is incentivised on revenue growth and EBITDA margin expansion. Two simple metrics, so they can get those up. Management makes more money, shareholders do very well. We like that.
Next up, we've got NRW Holdings, a diversified mining services company. Matt, I'll stay with you. Buy, hold, or sell?
It's a hold for us. I do like the whole space. I do think NRW's probably got a bit of earnings upside, and you'd be hard-pressed to find a management team in the space that's got a better acquisition track record than they do. They've really done an incredible job. The reason it's a hold is because NRW is primarily exposed to coal and iron ore as their own commodities. I want gold at this point in the cycle. I think the contractors who have gold clients are going to have more work available and easier opportunities to push through price rises and get margin, and potentially have better growth outlooks on similar or low multiples. So nothing wrong with NRW, I just think there's better options in the space.
Luke, what's your take?
Yeah, Matt and I saw these guys both at Euroz Hartley's in February last year. I think the stock was $2-ish, and they had sort of Whyalla as the big thing that was sort of hanging over the business. Would have been a really good buy. In hindsight, you probably bought it. We weren't smart enough to buy it. So, in hindsight, that was a really good time to buy the stock. I think, like Matt sort of pointed out here, there's less appeal now at the current share price. I think the incremental gain above market consensus here is maybe harder to get. I think mining services is a great space. Agree that there's a lot of opportunity there. For us, Emeco is probably our pick in the sector at the moment. I think though, Imdex, XRF, these are all businesses that, like what Matt's talked about, have got exposure to base metals and precious metals, which is probably where the cream is, I suppose, in the earnings at the moment. So yeah, there's lots to like in mining services, but NRW probably not the pick for us, another hold.
Okay, and finally, Integral Diagnostics, one of Australia's leading radiology networks. Luke, I'll stay with you. Buy, hold, or sell?
You'd think that, if you go by the rule of thumb that everyone rolls around, an ageing population and everything in health makes money, you'd think diagnostic imaging would be a better sector to be in. It's actually been a pretty average return sector. They kind of do 5% growth and 5% return on equity. It's pretty sort of mediocre in the grand scheme of things. Not a huge fan of this one. They've kind of had labour force inflation. They're a roll up. So, some of the best practitioners maybe don't want to work as part of a big corporate. They're facing these kind of, boutique challenges and offshoots. There might be some regulatory tailwinds here. I'm not a political animal. I'm not the best on forecasting that stuff, so maybe I'll leave that for brighter minds. But yeah, probably not for us at the moment, IDX. I know why everyone likes it. I kind of get it. But yeah, that doesn't really fit with the way that we're looking to invest at the moment at Seneca.
How about you, Matt?
Yeah, I think it's a buy. I will say I agree with Luke. It's had a very checkered history. The share price has halved over the last few years. There's been a number of missteps by old management. I'd say where it's positioned now, though, is you're seeing the industry data come back for radiology. So the industry growth numbers have actually bounced back quite strongly, which I think was a long COVID hangover, which is finally rectifying itself now. There are some regulatory tailwinds, so deregulation of MRI licenses, national lung cancer screening should be a good volume kicker over the next few years. So there's some good top line aspects there. On the cost side, I think there's more cost out through the Capital Health acquisition in terms of synergies than what people realise. On valuation, there's quite a good basis. There's been a number of private equity type deals in the space over recent years. They've all been priced well above where Integral is trading at. So I think that tells you the stock's cheap, and we think earnings have reached the inflection point now.
So I've also asked each guest to bring along one small cap stock each that they like for the next 12 months, ideally tied to one of the themes that were mentioned earlier. Matt, what's your pick?
Yeah, I've gone for a gold stock. It's one that's flying a little bit under the radar, one of the smaller developers moving into production. It's Meka Metals, MEK is the ticker. Mm-hmm. This stock has just commissioned their mine, which is a restart of an old mine. So they'll go through the usual commissioning ramp-up issues that people have, but importantly, I think they've got a very good team in place to manage those issues. So I think we should expect a fairly smooth ramp-up. They should be cash flow positive pretty soon, so that will potentially see a re-rate as they trade on a producer-type multiple. And there's two areas of upside there over the next few years, which I don't think are priced into people's numbers yet. Firstly, I think the geologists have been quite conservative in the way they've done the resource, so there should be a fair bit more material there than they thought, more gold in the ground. And secondly, there's quite a logical plant expansion project, potentially double production over the next few years, which I don't think is in people's numbers. So this is a stock that, absent the commodity price, we still think it can double over the next few years, just on those drivers alone.
Okay, Luke, what's your pick?
Yeah, I'm going to go with one of these kind of semi-distressed situations, I suppose, and Regal Partners, RPL. So, they're a big global fund manager based here in Australia, one of the largest, probably biggest payer of brokerage, I think, in Australia among the stockbrokers. But, they had a few investment missteps up there on the front page of the AFR. Huge story, lost $220 million. Stock got kind of thrown out. But the reality is Regal are kind of focused on all the right areas, Aussie small caps, water rights, royalties. We think these are all, far better, I suppose, exposures for a fund manager, sort of funds management house, than say a Pinnacle, but who are more focused on kind of private credit, which is where they're getting most of their fund flows from, which we think is probably at peak or maybe even past it now. So I think from our perspective, Regal's still cheap relative to Pinnacle, relative to historical multiples. It's growing quite well and probably got some upside still to growth. So we think that's a pretty good stock at the moment to own. And while the small cap rally is going to continue, no reason why Regal shouldn't be spitting off fat performance fees and hopefully surprising to the upside.
Plenty of variety there. If you enjoyed that episode of Buy, Hold, Sell, give it a like, and don't forget to subscribe to our YouTube channel. We release new content every week.